And welcome to the Cyclical Investors Club YouTube channel. As always, this is not individual investing advice. It is just for educational purposes only. Today we are going to be looking at Merck stock and where we think it could be in 4 years. So this is similar to the Medtronic video that I put out and the Consolidated Edison video that I put out. And it's we're basically just going to go through a recent article that I published on Seeking Alpha, and I'll have that link in the description, and I'll run through and kind of describe the types of things that I'm using, thinking about, measuring, all that kind of stuff. So I picked 4 years because it's long enough into the future that earnings kind of start to matter in terms of its relationship to price. If you go too long into the future, for an individual stock, earnings can be hard to estimate. Whereas if you were just looking 1 quarter ahead or something, you could get relatively close if you were trying to figure out how much they earned. So, but it takes time for the price sometimes to follow the earnings trend. And so 4 years is a pretty good time frame where if something weird happens or interest rates change, things like that are kind of going on now, over time, what little blips and dips can kind of have a better chance of working themselves out, while you still have a chance of kind of projecting future earnings. This is pretty important for a pharmaceutical stock too. I use this method pretty sparingly with drug stocks because the way that patents work, when things go off patent, it could mean especially if they have one dominant drug that is producing most of the earnings, that can change the earnings trend of the previous 10 years or whatever. So it might not carry through. So I try to only usually buy drug companies using this particular valuation method if they have at least kind of 3 drugs that are making a decent amount of money for them. And that they have a long history of producing new drugs. So you're kind of betting on that. Now, when you look at, with that in mind, I'll revisit this in just a moment, because a couple people in the comments section noted some of the things with patents as well, which I pretty much agree with. But you have to take a chance sometimes, even if things aren't perfect, even if you don't know everything, I guess is what I'm trying to say. So I actually am long this stock. I bought it so I wrote about it in May of 21, but we bought it in the Cyclical Investors Club on, I think, March 1st of 2021. So, and then I believe they had a spinoff as well. So if you include some of the proceeds from that, we're up about 70% or so on the stock. Since I wrote about it publicly, it's up about 50%, and the market's basically flat, right? So it's done well. But now we're looking at it now. Now the price has risen, so it's probably not going to be as attractive unless earnings have risen a lot and are expected to keep rising at a similar rate. So it's good to review these from time to time. I really haven't looked at Merck hardly at all, other than just my regular kind of quarterly updates on earnings and stuff since I bought it. So I like these kind of stocks. They can be kind of hard to find. They aren't exciting, but I mean, we've only held it less than 2 years and we're getting 50%. So it's in that kind of 20% per year, 15 to 20%. If we go another year, maybe the price doesn't move very much, you're in that kind of 15% per year ballpark that I aim for. So it's nice that you kind of do the work. You place your bet essentially, and then you don't really have to do too much after that. You just have to watch for things that are changing. So this has been kind of a success story, especially given that there wasn't very much in the market to buy at this time. Sometimes you just have to look for the stuff that nobody else is paying attention to, and if it's at a decent enough value, take a chance. So that's how we've done so far. Getting into the valuation here. So the first thing we always want to check is the earnings history of the stock. See if it can blow this up here. There we go. And what I do here is I'm highlighting the years in which earnings growth declined. So the green area is the historical earnings per share. And I don't have it on this graph highlighted, but first of all, I check the downturn, so I have those highlighted. And none of these are more than 50%, okay? So it's not a super cyclical business, which can be good to hold during times that the market is going through kind of a down cycle, which it is now. I'll have some more details on that later because it's not perfectly true for Merck this time around. But basically what we see here is a long period of kind of where earnings don't do much. They had a dip, they had a recovery. Now, of course, S&P 500 earnings during this time fell. The price of Merck fell a lot and got really cheap. Some of this had to do with potential government regulation in here as well that didn't ultimately materialize. So that explains some of this cheapness. But generally speaking, you have kind of a period of boring, going nowhere earnings, and then gradually they kind of take off and so now we're getting high single digits, 20%, double digits, and then this is into COVID. Which I think definitely this 24% year, that was definitely partially due to COVID, which we'll get into. But generally speaking, this isn't like a super cyclical business. So we wouldn't expect most of the time, unless there's like a big patent thing, like I mentioned before, where earnings just kind of fall off of a cliff. So we can at least use this to kind of estimate, the value of what it might be worth. So when we bought it before, we bought right about there, which was pretty cheap. I mean, it hadn't really been that cheap just on a PE basis since 2013 probably. I mean, so other than actually even here on a PE basis, it wasn't as cheap. We can actually get into the fast graph and look at it. Maybe I'll do that. Just to give you, this won't take into effect the actual earnings growth at the time, but it'll give you kind of a PE reference at least. So let's see, when I originally bought it on March 1st, so we're right about there, okay? This is a little after that, but right in there. So we're looking at a 12.6, we'll call it, PE. So even in March, it was at 14, March of 2020 during the crash. So it wasn't as cheap then on a PE basis. You get down to here, almost, but not quite as cheap, right? Here, not as cheap. Right here is basically the last time. So that was 7 years earlier, okay, on a PE basis. So you can kind of see that just using a basic PE analysis, it looked pretty inexpensive at the time, right? And then when you also include the fact that the PE was falling during this period, right, when the last time it was here, so the trajectory was down at that time, which would explain the lower PE. Over here, the trajectory, even leading into COVID, was up, right? So you have really, I mean, you have to go back pretty much to get an upward trend when it's still down. I mean, this is when it was really cheap here. You would have done a good job. You would have gotten good returns, right? Right in here. Before, when earnings were rising off the bottom, the PE was even cheaper than I bought it this last time. So that would have been a good spot for you to buy in the past. But it hadn't been that cheap in a long time when we bought it. So now we're back to looking at it now. We're going to try to do it, and we're just going to assume, let me get into, maybe I'll do this on the, one other thing I want to show everybody. So one thing to look at with drug companies on the fast graph is these, you have to shorten this in order for it to show you the individual years here. So now this is interesting. So this earnings growth is expected to decline this year to $6.88. Now this is, I think, mostly it's pretty much due to COVID. We had kind of a COVID boom here, and then we're going to have a decline. So we kind of know what's going on here, all right? It's not like Keytruda is disappearing, kind of their main drug right now. So, and if we look at analysts who actually cover this stock in detail, which I really don't, I mostly look at earnings patterns, and then occasionally I'll kind of dig in deeper if something doesn't I'm curious about. But these are analysts' averages, expectations, who actually cover the stock. So they're going to know about patent expirations, and they're going to know about these. And these are things that you will find in drug stocks if you look forward a couple of years. When they look like super cheap, I don't know what one off the top of my head that is like maybe Amgen. I'm just going to take a look here. I'm gonna try to find one really quickly that's like super cheap, but there's like a reason for it. And analysts are kind of expecting the same here. I'm not sure if I can. I probably can't think of one off the top of my head, actually. Oops. Maybe Pfizer. Well, Moderna. Moderna is a good one. But it's COVID related. It's not like a patent thing. So here you go. So people got really testy with me a couple times when I was warning them about Moderna during this boom here. And they just were really convinced that, Moderna was going to do awesome and everything else. And I was like, well, it looks like it's mostly COVID. They might do awesome long term, but if you're paying these kind of prices, let's put it this way. So 14, 15 PE looks cheap until you look at what happens when COVID is gone. So, and analysts understand this. So they're predicting earnings losses, not just declines, earnings losses again, and then maybe we get like a little small profit over here in the future. So this shows you these are the people that actually cover the stock and that are doing work specifically on this. Now, they don't pay any attention to their price targets because analysts' price targets are worthless. But if you look at what their earnings expectations are, especially for things that have clear, like patents and drugs and things, they kind of have an idea. I have another good example. But so this is one I warn people about, and once the stock price starts falling down, then people start to doubt their thesis, and then once earnings fall down, then they doubt it a little more. And when they go negative here, it's highly unlikely this price stays here. It looks cheap. So if you look at it, it's like an 8 PE, but you have to look at the future and look where the earnings are going to go. So I'll tell you, actually, I remembered a stock that I kind of learned this lesson on back many years ago. It was Gilead. So Gilead has this fantastic antiviral vaccine, or viral vaccine, that literally stops certain forms of hepatitis, right? So some point in here, at some point back in here when this was just initially hitting the market, and the price was coming down, it looked like super cheap, right? I don't remember when it was. I think it was 2015 maybe. So I made the same mistake kind of that the Moderna people basically just made, which is how I learned it. You make mistakes and then you're like, okay, I see what I did. I'm not going to make that mistake again, or try not to. So let's just say I bought it somewhere in here. Maybe it was when the price first started coming down, like in this seems about right, around $100 a share. Well, and at an 8 PE, it just looked like super cheap. Well, if you cure people of a disease, you earn a lot of money up front, but it doesn't just keep rolling in. Once that disease is cured over time, then your profits go down unless you have some other, product that's going to come in and fill the gap. And they did. I mean, this is where earnings ultimately leveled off at, kind of where they are now. And now we'll wait for the next things that they can do in order to see if they can continue. But this is really a great example because if you bought around $100 a share when I bought, and you held through, I don't own this anymore. If you held through today, your total return is zero, right? From 2015 to 2023, 7.5 years, you would have earned nothing. All right. So, but analysts predicted at least these first couple of years. If I would have looked and said, oh, earnings are going to come down. Now, we didn't really know where they would probably bottom at that time. So, and I guess if I was going to defend myself, I would say, yeah, I saw earnings would come down here or maybe here, but I didn't know they would come down this far. I thought they would level off kind of up here. So, but analysts will see this coming, just like they saw it with Moderna. I mean, you just have to keep an eye on it. And they might be a little bit late, so in terms of the stock price, right? So that's why you have to kind of use your brain a little. I mean, COVID was kind of easy. We knew eventually that it would just burn itself out unless there was continuously like new and deadlier variants that came along. So, but this is more normal issue. And then eventually you'll have patent issues that kind of work a similar way. All right. That was a good sidetrack, I think, that it was unplanned. So back to the Merck analysis. So since I'm using earnings per share, I like to see how much stock they bought back. They haven't bought back much in the past couple of years, but they have, during the period that I'm going to use from 2015 to 2023, bought back about 11% of the company. So I'll make adjustments for that, which will make my estimates more conservative. So in the time frame that I chose was 2015 to 2023. So I'm going to look forward and see. I want to use these conservative earnings declines here after the decline. So we're going to use this more conservative number, and then that works out to, which is $6.88 per share of earnings this year. And that works out to a PE ratio of 15.94, and the earnings yield is 6.28%. All right. Now the earnings growth rate, after we adjust for this decline here, I think that was the only declining year they had, and then also the buybacks, worked out to about 7.45% earnings growth over this time period. All right. So these are the things we're going to use to estimate the future returns of the stock. So this earnings yield this is like if you bought the company for $100, it would pay you $6.28 per year, year after year, and you could just keep those for yourself, right? That's how I think about it. And then what we do is we say, okay, and that's going to grow. That $6.28 is going to grow at 7.45% each year. And what I want to know is how much money would I collect after 10 years, if that was the case, okay? And down here I post a table where I show this is how much I pull the first year growth forward. So $6.28 plus that 7.45% gives you $6.74. All right, and then that grows, and then it accumulates over here. And at the end, we have our initial $100. We would have earned $95 in earnings. And so we would start with $100, end with $195, 16. And if you plug that into a CAGR calculator, you get 6.92%. So that would be how much I would expect the stock price to rise on average per year over 10 years. And what I'm just going to do is take that and apply it to 4 years, because it's harder to see 10 years into the future, and it's kind of hard for people to wrap their minds around a little bit more. So that works out to about a 30% gain over 4 years. Not super spectacular from here, but given that the market is pretty expensive, which we'll see in a minute, that's not too bad. So using this same method that I used for Merck, if I use that on the S&P 500 stocks that fit this category of stocks, which is roughly half of the index and about 2/3 of the weighting, I would expect it to earn about 27% in the next 4 years. So if we compare those, Merck would, assuming sentiment and everything else stays the same, and earnings kind of come in as expected, we would expect Merck to outperform over 4 years by 3%, which is basically the same. And then cash, I expect to return about 4% a year on average over that time, which is 17% after 4 years compounded. And it would outperform cash by 1,300 basis points or so, which is still about the same. I mean, there's a pretty wide fluctuation. These are just estimates, averages, and we just want to get a rough idea of kind of where it stands in terms of what it might return on average, and then how that compares to cash, which is T-flow, or short-term. Those are short-term treasuries, and then the index S&P 500. So The next part of this, I assume that the market and everything and sentiment reverts to kind of a market long-term historical mean, which is about 7% CAGR, and which is roughly equivalent to 18 PE and 10% earnings growth. So it's not particularly bearish or especially bullish. It's kind of an average. The market doesn't usually trade right at that average, but it kind of fluctuates around it, and it gives you kind of just, if you're doing a valuation, it kind of gives you an idea of what to expect. Now, in Merck's case, it's almost at 7%, so we should know right away that there's not going to be too much adjustment. It's going to, but the market is actually a little more expensive than that. So Merck's looking pretty average here. And the market is a little more expensive, so we see Merck's relative returns improve. So it would, if earnings revert, it would bring in a slightly less, like 28% instead of 30, basically the same. But the market would only bring in 13%. So Merck would perform better. And again, with cash, it stays the same as it was before because it's cash. And Merck would perform slightly better. So, and really, if COVID sales and stuff, that $6.88 per share this year, that could easily be a little bit lower. So if that comes in a little bit lower, I mean, Merck's dead center, pretty much market average returns. It's kind of right exactly, as the center point of like what a hold would be. It's probably not going to do great. It's probably not going to do bad. Should be positive, all other things considered. And so that's exactly what a hold stock is for me. And then we just, we have some estimates there to go from. This is explaining kind of the larger context of everything. You can read this in the article that I'll link, which I'm putting in all my articles now. So to get down to the numbers that I'm looking at, assuming earnings stay where they are, earnings expectations for this year are not a lot higher or a lot lower. If it rose above $157 per share, I would sell, because it would be overvalued enough that the future returns would be low enough that I could pretty confidently sell and do better in cash or the S&P 500. If it fell below $98, it would become a buy and likely outperform the market, but there wouldn't be a margin of safety there. So this price is kind of for people. I always complain in my articles that my buy prices are too low, which my buy price is below $79. And I think even on this article, somebody was like, it'll never hit $79. And I was like, well, the buy price is what a buy price is, because I have certain returns. You saw, I've gotten a 70% return already, and that's the type of returns that I want. So I'm not going to pay more to get lower returns. I'll just find something else. So, but if some people don't want to wait that long, or they really like Merck or whatever, then $98 is, assuming earnings stay kind of where they are now, is the point where they could probably do a little better than the market if they buy. Now, if they report earnings and they're much lower than expected, all these prices would come down, but the most relevant one would be this, because it's not really that far. It's only like maybe 10 or 12% or 15% away from here. So if they report earnings and the stock falls, you would want to make adjustments before you go in and buy at this level. And that's why I really prefer to have a margin of safety. Kind of these marginal areas, it gives you a little more time sometimes to let earnings play out, and you get more information while you're waiting. But you have to watch a lot of stocks in order to not miss opportunities too. All right, that was my Merck and my drug company warning overview for using earnings. I've had pretty good luck so far, but I'm usually pretty conservative when it comes to these. I really want them to be cheap. I really don't want there to be a lot of other alternatives in the market. I mean, if I get into that kind of situation, that's usually when I buy these. So I own this one. I own BMY. I owned another smaller drug company, which I almost never buy, which got bought out right after I bought it. So it worked out really well for me. But I'm pretty conservative, and like I kind of really dug into that one, and everything looked good, and I wasn't the only one that thought so. So, subscribe if you haven't. Check out the Cyclical Investors Club. I'll have the actual paid version. I'll have a link to that in the description, and a link to this article on Seeking Alpha if you want to go read that. And I'll see you in the next video.